What's up, Judah?
How much, man? How are you?
Not too much. Happy Monday.
Hey, happy Monday to you too. Had a great weekend and an absolutely awesome, uh, productive morning here. The world of real estate is popping off, and great, wonderful things are happening, dude.
Yeah, man. Dude, how about this weather? It was so nice and cool. It was amazing this weekend.
So I actually said that to somebody. I was sitting outside having some brunch on Sunday, and I said, usually I don't like fall weather because like it's crisp enough to remind you that winter's coming. And this weather was just absolutely beautiful and wonderful. I was really soaking it in and enjoying it. Plus, the weather was really calm. I was able to get three skydives in on Saturday, so that was nice. I didn't get back on
Oh,
Sunday.
all right. I want to know how you jump out of a plane frequently and are still walking the planet.
Well, I wear a parachute, and that parachute has a reserve. So, and besides, like I'm at like 85 jumps.
Right.
Most skydivers that I interact with have 300, 500, 7,000 jumps. Like it is, I am a baby at 85 jumps in the skydiving community.
Oh,
Yeah.
okay. All right. That's cool. All right. So, welcome to the Build and Grow with Real Estate Show. My name's Josh Weidman. My host over here, I got it on the first try, is Judah Hoover. Today we are going to be talking about syndication. One of our listeners, an old client of mine, he's not old, but our relationship is a little old, contacted me after one of the shows last week, and he said, I don't think you guys really did anything on syndication. And he and I talked about a project. I was trying to syndicate a 12-unit apartment building. And this is a while back. And we had talked about it on a very preliminary level, and it was wrong timing for both of us. And then COVID hit and it was a mess, right?
Right.
But I think this is a really good topic because coming off of last week where we talked about hard money and funding your deals using hard money and a little bit of private money and things like that, syndication is a way to kind of take that step. If you've been flipping a bunch of properties, or you've been buying a handful of single family rentals, and now maybe you have 10, 20 rental properties, and you're like, man, how do I make that jump to a 50 unit or 150 unit apartment building? Syndication is a really good tool to use there. And I think, and so that's why we're covering it.
Yep. So I love syndication. I've syndicated racehorses. I've syndicated
Racehorses?
state. Yeah, racehorses. And I've syndicated a whole bunch of things over the years. I did a 342 unit deal in Tulsa, Oklahoma, that I was able to participate in, and I also when I was in the hard money business, I had a $10 million fund. I could only ever get like 7 million of it on the street at a time, but I had a $10 million fund. You know how that goes, Josh.
Yeah.
And but like around half of it was syndicated money. So you can even put together and fund hard money deals. Set up a hard money fund with syndication is another thing that you can do. So it's a very, 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 very hot topic right now.
Yeah.
And there's a lot of things that are good about it, and there's a lot of things that are bad about it, and there's a lot of things I don't want to say bad about it. There's a lot of really great things about it, but there's also some stuff that you just need to know and understand. And there's a lot of people teaching books, tapes, and seminars out there saying that syndication's easy and syndication's for everyone, and it's really not. So we're going to dig into it here a little bit and give you kind of a primer on syndications.
That's right. And throughout the week, we'll go into a little bit more depth on some specific topics. But rule number one with syndication is don't lie. Because if you lie in a syndication, instead of just losing your reputation, what you do is you go to jail.
Right.
So that's a big one. All right. So that being said, let's jump in here. And I think the best way to start here is to talk about the pieces and the roles in a syndication deal, right? Just like single family properties, in a syndication deal, the most important part is the deal itself, right? And typically, let's say we have a 120 unit apartment building that we're starting with. The as is value is $3 million, or it's for sale for $3 million, or there's a contract on it for $3 million, whatever the actual value is. and there's some value add to the project. So imagine a BRRRR. A lot of people are really familiar with the BRRRR strategy, right? Where you buy, renovate, um, rent, and then refi. Okay, it's the same kind of a scenario here. We're going to buy low. We're going to do some value add things to the building, including like maybe increase leases, maybe renovate, add some renovations, things like that. Ultimately, it's going to improve the value of the property and give us a much higher ARV. Okay, that's the simple part. The next role here is the sponsor. So the sponsor, is kind of like the I don't know. Well,
They're the boss. They're the ones who put it all together. They're the ones who are making it happen. They're the
exactly.
they're the epicenter of everything. If it's meant to be, it's up to them. You know what I mean? I always say, if it's meant to be, it's up to me. If it's going to happen in the deal, the sponsor is the one who's got to see to making sure that it happens.
That's exactly right. And this is the second most important part of a deal. If you're thinking about investing in a syndication, you have got to have an operator that is high level, that can execute time after time after time, because there might be all the money in the world there, but if they're not getting their job done, it might be a phenomenal deal. If they're not getting their job done, you're not getting paid. So
Right.
make sure that you're dealing with a good operator. They're going to bring the deal and the plan. They're putting it all together. Oftentimes, they're going to be bringing capital into the deal. It might not be hundreds and hundreds and hundreds of thousands of dollars, but they're going to have some of their own money in the deal. They're going to be executing on the plan. And oftentimes, they're going to charge a fee for you to be involved in the project. And sometimes that'll be related to the construction or related to, the acquisition price of the property or whatever. But there's going to be fees involved. And then they're going to share in the profits when the deal's done.
Right. And those fees are usually pretty reasonable upfront. Usually a 1 to 3% transaction fee when they close, and it's just because of all the costs that it's taken them to get to that point.
Well,
I one time wrote a check for $15,000 to a demographer to do some pretty deep insight and research, and that's how people say Tulsa, Oklahoma. How'd you do a 342 unit deal in Tulsa, Oklahoma? Well, I paid a demographer $15,000 and said, where should I be buying real estate? And I found Oklahoma City, and then went out and actually spent time in Oklahoma City and met some people and got to. So I spent a week on the ground. I flew out there. I interviewed a whole bunch of people. I met, people. So my lost productivity and other things like that was valuable, that I, deserve to be compensated for. And yeah, what Steve says here. Oh, okay.
I because I was thinking of John Hoover when I
Right.
when I picked up the sponsor, right?
Hey, there's a lot of badass chicks right now in real estate.
Oh yeah, oh yeah.
And what Steve says here is good. Being a transaction engineer, that's really what your job is. Your job is to be the rainmaker who brings everything together and makes it happen. Because I usually utilize that term in a slightly different context, being a transaction engineer. That no matter what deal comes to you, whether it's a wholesale or a retail or a flip or subject to, like, you need to be able to take down any type of transaction that comes to you. In this case, being a transaction engineer is you've got your transaction engineer hat on, and no matter what needs done for this deal, you're going to either do it yourself, learn how to do it, find somebody to do it. But like the buck, it was Teddy Roosevelt who said the buck stops here. If you're the sponsor on a deal, the buck stops here. And you need to understand, first and foremost, you should not take on that responsibility lightly. And you probably shouldn't take on that responsibility until you've participated in 2 or 3 or 4 other people's deals as a investor, as a limited partner.
Well, okay, so that goes into our next role, and I want to say one thing about the transaction engineer. A lot of people think a transaction is like getting it to closing. Once you
Right.
close on the deal, that's the beginning of the job.
Right.
Like
Right.
oftentimes this is a multi-year commitment. And for the purpose of this example, we're going to use a 1-year commitment. But
Right.
let's say, on these larger projects, these are how skyscrapers are built. These are
Right.
how, large development projects are done. when you need to fill the gap of a couple $1 million on a $300 million project. All right. So
All
now
right,
we
Steve points out here it was he says it was Harry S. Truman. By the way, bonus points to Steve for not putting a period after Harry S. Truman's name, because the S in Harry S. Truman actually wasn't an abbreviation or stand for anything. He only had a middle initial, did not have a middle name.
That's hilarious.
Useless trivia fact for you on Monday.
That's good stuff. That's good stuff. All right. So now you have the investors, right? These are the limited partners. Okay. They are bringing capital to the deal. They are accredited in most cases. These are investments that everyday Joe Schmo does not qualify for.
Right.
And let's talk about what is a accredited investor. I mean, there was some the SEC just changed some of the guidelines for accredited investors so that people with more experience and not quite the income can invest.
Right. They blurred the line because it used to be accredited investor and sophisticated investor. And they kind of just said that sophisticated investors are now accredited investors. Is kind of sort of how that went. And that's really important because, you can bring anybody into your deal you want. When you register your transaction with the SEC, the Securities and Exchange Commission, the same people that regulate people selling stocks, bonds, and mutual funds on Wall Street. That's who you're talking to when you're doing this. And when you go through those processes, you have to demonstrate a whole lot less. It's a whole lot easier. It's a whole lot simpler. It's a whole lot. It's just a whole lot easier if you tell them, hey, listen, I'm only going to be taking money from accredited investors.
Yeah.
Because what that tells them is that you are only looking for people that have a higher level of financial IQ, and that they don't have to look at your deal as much to make sure that people aren't going to be getting hurt by it.
Now, when let's say that somebody didn't have all of the disclosures and all this stuff that they would need with more of a retail investor.
Right.
When might that come into play?
Well, if you lose money on the deal or the deal goes sideways, if the deal goes sideways for good reasons or bad reasons, you know what I mean? Sometimes the deal goes sideways because there was fraud and nefarious activity and other things like that. And sometimes the deal goes bad just because guess what? A deal goes bad.
Exactly.
So you want to, and when a deal goes bad, people try to blame incompetence and fraud and malfeasance. They don't want to believe that, hey, listen, this was just market, conditions, and this was beyond what we could control. So, so you want to really, really, really protect yourself from that by only working with accredited investors, because there's more burden of
the burden of proof and the burden
of more burden of like due diligence.
Yeah.
The burden of diligence is more on them, that the government basically says, hey, listen, Tom Smith, you should have known that this either was or wasn't a good deal, and if it ended up not being a good deal, you certainly were told that you might end up losing your money. So
right. So these investors, these LPs, they're going to provide the bulk of the capital here. They're coming out of pocket for most of the money. But they're silent partners. Like, they have little or no involvement, and a lot of funds like this, they will have when a lot of these funds, the LPs are like, it'll say in the bylaws, they have no rights to jump in and make changes or influence anything, and oftentimes can take a lawsuit or withholding additional funds if there's a capital call or something like that, and when it's needed or occurs.
Yeah, so this is Chris's. Chris has a really good point here that I think we're going to answer later on this week, that is, if you are going to be investing in syndications, how do you evaluate them? What do you look for? What are some red flags to be, and kind of from there.
Well, and even on the surface, even on just what we're talking about right now, you got to make sure it's a good deal. Like, you're looking at the plan, and like, that's the first thing. And if that checks out, look at the sponsor. Have they done this before? Is this something that you've seen them perform in the past. There's obviously additional steps there, but Chris, good question here. All right. So now the mechanics of the deal, right? Here's how it works. First, you've got, let's say Mary. Mary finds this apartment building, and she's like, all right, the market rents right now are $1,500 a month for these units. There's 120 of them, and right now they're renting for, 800 a piece, and half of them are vacant. And the reason is the place is a dump. It's in a great area, but the place is a dump. I think if we buy this thing, if we're able to get this thing and renovate it and put new tenants in, this is going to be a really nice deal. So she says, look, she negotiates a deal for $3 million with the seller. Says, look, I'll take your problem away from you. I'll give you $3 million. You're going to end up walking with 300,000 because you have over leveraged mortgage on the place, yada, yada, yada. She gets it under contract.
Just like people don't maintain their rental properties like they should, and therefore are willing to sell them at a discount, or people get inherited apartment complexes and they're willing to sell them at a discount, or it's actually a pretty good property and they need to sell it to raise funds to solve other problems, and they're willing to sell it at a slight discount so that they can raise the funds that they need to solve other problems. There's all kinds of reasons. Just like someone would sell you $100,000 house for $50,000 all day long, if you know how to look and you flip over enough rocks, there are people out there that will sell you an $8 million apartment complex for $3 million.
That's right. That's right. All right. So now the next step is the GP puts together a plan. And this has got financial projections, and she says, okay, right now they're paying $800 a month. Here's what it's going to look like when they're paying, $1,500 a month. Here's what it's going to take us to get there. Here's the timeline. And these are all of the expenses that I can think of that would go into this deal. Here's how much money I need. Right. Ends up in $6 million, right? Boom. Now she goes out and she goes and starts talking to people. And she puts together this plan, and she says, listen, Mr. LP, I know that you have, $20 million and it's diversified and all this other things. I'll bet you have 500,000 to invest in this project. I'm raising $6 million to do it. Here's the kind of returns you can expect. Here's the timeline, and lays everything out. Once
lays everything out in a document called a private placement memorandum.
That's right. That's right. And those things are not cheap. I forget who we had on here a couple weeks ago from New Jersey, but he was saying that the docs are like $10,000. I've seen them cost $50,000. They like 10,000 might be the basement. But anyway, long story short, the GP starts raising money. They have a deadline for all of the LPs who are going to be in to sign the operating agreement and to wire the funds into the operating account for the company. The funds are wired in, and now the fund is closed. At that point, the LP or the GP is going to purchase the building in the name of the limited partnership, and that's when the fund begins, right? Just like you go to closing, whether you're getting a hard money loan or you're funding it in cash or whatever. At this point, typically, now Judah said there was like a 1% to 3% fee on this. I've seen fees a heck of a lot higher, and this is part of the type of investment, and kind of goes to one of Chris's questions. Right now there are a lot of people that are raising capital using limited partnerships and funds and things like that, and they're charging fees. Like their business model is the fee model, where they're putting the deals together and they're getting fees up front when the fund closes that are based on, getting the deal done, essentially. And then they're getting a back end fee as well, or a percentage of the profit that, I've seen 4% on construction, 5% on acquisition. I've seen higher numbers than that, but it really depends on the fund, what kind of profits they have, what kind of deal they can negotiate. That has a lot to do with it.
Right.
All right. So now the funds paid, everything's raised, and all right. Now the GP is going to execute the plan. We said, all right, for the first 3 months, we're going to do demo. We're going to renovate these units, and we're going to begin to go. One One thing that you often see on multi-units is a tiered approach to these type of projects. It's very often where you have a 120 unit building where all 120 units are vacant, maybe 70% or 50% are occupied. That's a real asset when you're going into an investment like this, because you have cash flow to offset the daily operating expenses. And oftentimes the limited partners, they get a preferred interest rate on their money. So they might get an 8% return on their money that comes from the first fruits of that are coming in from that deal. And if you've got cash flow coming in on this property from day one, it allows you to offset some of those costs. In the financial model or the breakdown or overview, whatever you want to call it, that I'm going to pull up here shortly, I didn't have any of that stuff. So anyway, the GP is executing, and now we get into boom. Now we get into the refi. All right, this is going to lead to something called a waterfall. And if you think of a waterfall, or better yet, you ever see those towers of champagne glasses where they start pouring the top glass and it overflows, and right? Think about that when there's capital coming in, large chunks of capital that are coming into this partnership. All right, the waterfall is a description of the way that these large chunks of capital are paid out to the investors, the LP, and to the GP throughout the process. Oftentimes, yeah.
Here, let me just explain this. So let's say I go to Josh and say, hey, Josh, I want you to invest your money with me in this deal. And I'm going to be the guy who puts it all together, but I need your money. And then what we're going to do is we're going to split the money 70-30. So you get 70% of the return. I only get 30% of the return. Okay. I'm going to do all the work and everything like that. I'm only going to take 30% of the return. So I'm going to profit 30%. You're going to profit 70%. But I'm willing to do one step even further for you to make this even more secure for you. And maybe that's 50-50, maybe it's 70-30 the other way, whatever you can negotiate.
Yeah.
But you also negotiate what's called a promote or a guarantee or a hurdle or a waterfall. These are all terms used interchangeably for the same thing. Say, Josh, what I'm going to do is 8% is actually going to 8% return on your money is actually going to be treated like as an expense. So you're going to get a guaranteed return on your money of 8%. And then you and I are going to split anything above that 70-30. So yeah. I don't actually make any money until you make your money back and make 8% and make 10%. I'm working on a deal right now where I'm offering a 20% promote. So like it all depends on the deal and the investor and a number of different things like that. 8 to 10% is pretty common. 50-50 is pretty common, but sometimes sophisticated sponsors with a good track record. Sorry, I can't get my brain on a second gear here. Sometimes sophisticated sponsors with a good track record, it'll be 50-50 or 60-40 in the other direction, where they'll actually tell people, hey, listen, I'm taking 60% of this deal. I'm only offering up 40%. If you're in, you're in. If not, that's great. Capital is really cheap right now. So, your sponsors are able to raise money easier than they have been any other time, but deals are also very scarce because there's so many sponsors out there looking to put together deals. And also because the economy's been as strong as it has been, there's less troubled assets out there. Now, who knows, that might change in the next, 2 to 6 months to 2 years. But there's a whole lot of reasons that just like it's hard to find flips right now, it's hard to find apartment complexes.
That's right. That's right. All right. So now.
All right, we got way off track there. You were talking about waterfalls, and I.
Well, no, it's. The waterfall is just the way that the money is distributed anytime you have a taxable event, right? Whether or a refinance. Okay. Right. So now we've got a situation where we have the LP is repaid their initial investment. Okay. And all the owners share the profits in that waterfall breakdown. Okay. In this type of investment here, most of the time the exit strategy is not going to be a complete a flip, right? We're not talking about flipping a property. This is for a long-term hold where the bank is holding most of the risk here with a 70 or 80% loan to value, but we're filling the gap, the initial gap, to buy and renovate the property and all the ancillary costs that go with that. And then once we get to the end of the project where the thing is leased up, where we've got the highest value that we can for that property, now we're going to refi it, get the money back to the investors, and retain the asset. And so these LPs, they're going to continue to own that property, and over time, they're going to continue getting paid month after month based on their percent ownership in that building. A lot of the GPs and even there are a handful of LPs that are in real estate. You'll see them say stuff like, I own 5,000 units or 50,000 units or whatever. Most of the time, what they're talking about is they've been part of several syndications where they own a 25% ownership or a 5% ownership in a large project like this.
Right.
There aren't a lot of people that own 50,000 units across the country in themselves 100%. All right, so what kind of numbers do you see like this? All right, let's say that this is a 12-month project. We've got hard costs of $3 million to purchase, $1.25 million in renovation, $500,000 in leasing costs, and that can be broken out. Typically when you see a pro forma on a project like this, these things are going to be broken out specifically, like advertising and marketing, lease incentives or commissions to leasing agents, things like that. We've got our promote fees here. I got 5% on the acquisition and 4% on the construction. Soft costs. This is an LP interest at 8%. We've got professional and legal at $75,000, holding costs and closing costs, and all the other miscellaneous stuff that goes with it at about $500,000. If we figure that the building is worth $9 million.
So there's the one thing that we're missing here. We missed it before. We're missing it now. Is the element of time. So about 6 to 18 to 2 years, to 6 months to 18 months to 2 years is going to go by from the time you purchase to the time you refinance or sell. If the value is there, sometimes it's better just to cash in your chips and go look for another deal. So what you've done is you've rehabbed the property and raised rents, or just turned over and kind of freshened up units and raised rents and done things like that.
Right. So for this example, we're saying 12 months. Let's say this takes 12 months, which is a really short time frame for a deal like this, right? But let's just say that that's the timeline. What we end up with is $1.275 million in Waterfall funds. And if you combine the LP's distribution of 70% and their interest, their rate of return ends up being 21.5%.
Right.
Now, if you're sitting there and you've looked at the interest rates right now, and you're looking at, the investments you can get in the stock market or in bonds and things, and more retail type investments, 21.5% is astounding. Right. But believe it or not, like the way that these things work, by the time you put in 50% of the rent roll, over a 12-month period, and escalations to get the thing leased up and everything else, it's likely that, it's not uncommon to see projections from these type of investments on the low end at 15% and on the high end at like 25 to 50%. And, if they deliver, they're great. They're great returns, great investments. The issue that a lot of times you have with these deals is because they're a longer timeline, you don't really know what life's going to look like in 5 years from now.
Right.
And the lending climate can be different. The values can be different, things like that.
Yeah, these are a great way for limited partners to build their wealth. This obviously isn't going to, if you had $50,000 or $100,000 to invest in something like this, it's not like it is going to help you quit your job or anything like that today or tomorrow.
Right.
Most real estate investors find that they would do better just in reinvesting their money in their own business. So, using that money to buy marketing and pay for some VAs and other things like that. But we wanted to give an overview here of what the process looks like, so we can dive into it in more detail and decide if this is a goal that you want to go into and something you want to set yourself up for or not. The other thing that I'll just really quickly mention here at the end is, at the end, if I'm a syndicator and I'm putting together a deal and I bring Josh or a pool of Joshes in, when I refinance, sometimes I refinance and pay Josh off and Josh goes away, and sometimes I pay Josh his money back and some interest, and Josh still participates in the deal with me, maybe at a lower percentage of ownership or something like that. So there's a number of different ways that they can be structured. Hey guys, we are 1 week away from a really awesome and exciting event. We're doing a partnership with Note School, and they train people and teach people about raising private money, about putting together the note business, about how to buy and sell notes. And we are doing a Gold in Notes event. I was actually just talking with my brother this past week, and our uncle died, and I was getting a lot of his old books and things like that from back, going back to the 80s and 90s. And my brother Jared and Jared was one of my first real estate partners. We talked about how we got started in the note business. It was the note business that really turned us on to real estate and things like that. And the concepts that are taught in the note business and understanding the note business could really help make the rest of real estate make sense. So get registered for this event. It's going to be on Saturday. It's an all-day event from 9 a.m. to 3:30. We're going to take a little bit of a break in there for lunch, but lunch is on your own. We're not paying for lunch. Noteschool.com/BGRES, Build and Grow with Real Estate Show. And I think we're going to have Brian Lochner back on again here sometime soon.
I think he's going to be here Thursday. Yeah. So that's awesome.
That's all I got.
Yeah, that's it for today, guys. We'll be back here talking about syndication again tomorrow at noon. If you enjoyed today's broadcast, make sure you like and share the show. Until tomorrow, go make some money. And we'll talk to you tomorrow. Thanks, guys.
Everybody.